All right. Everybody, thank you very much for joining. I am, it is not an exaggeration to say, thrilled to be joined always by Drew Dokken, but by Mike Green. Mike, thank you very much for joining us. I would just say, as a way of background, there are a few people who I've learned a lot from, I would say, over the last few years. I'm definitely a believer in being a lifelong learner. My historical P&L suggests that I better be a lifelong learner. But what I have learned from Mike in terms of understanding passive flows, understanding how the economy is not the market and how market structure has changed, has been super important to me, basically to keep me out of being too bearish, because I have had a more sort of negative and stagflationary economic view. So it really is a thrill for me to be on with somebody that I have learned so much from. Before we get into talking about a lot of what you talked about, and it certainly goes way beyond passive flows, some of your recognition of the weakness in the labor market and the weakness of the data has been another area where I've learned a ton from you. But let's just get in a little bit to what your day job is with Simplify, with Tier 1 Alpha, where you're partnered with Hedge, which is another entity that I've learned a hell of a lot from. But why don't we start with the Simplify side?
Sure. So at Simplify, I'm largely in charge of maintaining the firm's kitchen and keeping the dishes clean. I am the chief strategist and portfolio manager for Simplify Asset Management. From a chief strategist perspective, that means I do a lot of events like this, podcast appearances, whether it's on CNBC or Bloomberg or Fox, et cetera. And also increasingly, the long form media as well, which has been incredibly generous in giving me the opportunity to expand some of the thinking beyond the sound bites that you typically get on traditional media. My day job is really managing our high yield portfolio. That's a product that's about $400 million in assets, crossed over its 3-year track record earlier this year. We're very fortunate that we've been able to figure out some market structure features to enable that product to simultaneously outperform the high yield benchmark over its history, as well as offer protection in downturns. We saw that play out really well in the March-April drawdown. And really what we're trying to do is take advantage of some of the stuff you've heard me talk either with David Einhorn about endogenous liquidity or the features and structures in the market that provide us with the opportunity to hedge some positions in a way that I think other people are slowly starting to wake up to, but we're still fortunately very far ahead of the pack in terms of being able to take advantage of those tools. So that's kind of my day job is continuing to manage assets as I've done for basically the past 30 years.
And the ticker on the ETF on that actively managed high yield fund?
It's CDX, which is a play on protection in the bond space. The CDS indices are referred to the high yield CDX. We are really trying to offer a product that gives the performance of high yield, but does so in a manner that is very risk mitigated to the downside by offering a hedge that really responds to credit spreads without the cost of a CDS type index. If you perfectly hedge your high yield exposure with CDX, with traditional CDS, you end up basically at a risk-free rate. That's not particularly attractive, although it's certainly more attractive than it's been for the past several years. By hedging the credit spreads, we're able to take advantage of the higher yield in high yield while capturing a return stream that is positively convex to credit spreads, which enabled us to ride out the April storm, for example, with very little damage.
And your pre-buy side experience, your training on Wall Street was in derivatives desks.
Actually, my pre-buy side experience was largely in valuation work. So I came out of the Wharton School of Business in 1992. It's hard for people to imagine a world in which Excel wasn't on everyone's desktop, right? The tools of financial analysis were not nearly as broadly distributed as they are today, nor were they as ignored as they are today, which is kind of fun. I developed an expertise in M&A consulting with particular emphasis on strategic acquisitions and divestitures for corporations, codified a lot of that work into a valuation tool along with a couple of partners, one of whom I'd gone to school with. We sold that business in 1999 to Credit Suisse. Today, some people will know it as Holt, which is now embedded within UBS. It actually plays a role within the CDX product in helping me construct that overlay, that hedge overlay. In 99, I transitioned into small cap value, managed separate accounts, did very well through the dot-com crisis, took advantage of that opportunity, was recruited down to New York to run assets for, run mutual funds, both open-ended and closed-ended for Royce & Associates, which is the largest small cap specialist.
Yeah.
And then I was lifted out of Royce by Canyon Partners, which is a large multi-strat hedge fund at the time based in Los Angeles, currently in Texas. That was looking to expand their equity investing and their operations in New York. They had talked to them for well over a decade. They were actually one of my first clients on the software company. And they asked me to launch the New York office of Canyon Partners, which is what I did until 2014. Ran my own hedge fund seeded by Soros from 2014 to 2016. I was one of those fatalities in what was called the Soros bloodbath when Scott Bessent, who was the CIO at Soros and had brought in external managers like myself, when he left to launch Key Square in a fit of pique or retribution, Soros unceremoniously fired every outside manager that Scott had brought in. And that was the end of my running my hedge fund. Transitioned from there to managing Peter Thiel's personal capital. Did that for a number of years. And then in September of 2020, there was a regulatory change in the ETF space, colloquially referred to as the derivative rule, that allowed a lot of the strategies that I had introduced into both Canyon Partners and my hedge fund and Peter Thiel into ETFs, the ability to do something like construct a long-short equity overlay to protect against credit spread widening simply couldn't be done until 2020. And the ETF platform itself is actually far, far more tax efficient and more attractive for the individual investor than hedge funds will ever be. So that was a fantastic opportunity to switch over. We are now about $11 billion in assets across about 30 different strategies, everything from managed futures products to interest options, what are called swaptions, to products like CDX that offer the hedged high yield exposure.
Okay. It's amazing how your experience starting in small cap value has led you to, well, maybe not led you, but certainly contributed to how you think about how different, to use Einhorn's term, kind of valuation convergence, which doesn't necessarily exist anymore. But before we get to that, let me just ask about Tier 1 Alpha, because I do think that the work, and I have no affiliation with Hedgeye. As far as I can tell, Keith McCullough doesn't even like me very much, but they run if you're going to be a trader, I don't think anybody has a retail facing product that is better than what they offer and and that you contribute to with Tier 1 Alpha.
Sure. So Tier 1 is actually the research firm that we launched soon after Simplify. The idea is very straightforward. In the ETF space, you don't have the funds and resources. Your fees are much, much lower. You can't expend the amount of money that you would on research that you might have historically. Tier 1 is a tool and an entity that allows me to expand that research, in particular focusing on the impact of passive dominance and the growth in the options market, which as a regular reader of Tier 1, we believe helps to mechanically explain much of the behavior that we end up seeing in markets. And so our notes there focus on providing people with relatively actionable insights in terms of portfolio positioning, but much more importantly, in just educating people on how the market is behaving, why it's behaving this way, what are the mechanical features and properties that we can take advantage of. And I appreciate the compliment. We have been relatively successful growing that business. It is now actually profitable, and we're hopefully looking to expand distribution over the next couple of years.
Well, that's great. He's got to be a great partner for that. So let's get into what you're kind of, I think probably most famous for. And I'll take everybody back to a couple of years ago. If you don't know who David Einhorn is, he's one of the more successful long-short managers of sort of our generation, when Mike and I were growing up in the business through really the 2000s. He was probably most famously known for sort of proving out ahead of time that Lehman Brothers was probably the equity was worth zero. And he wrote in a letter to investors a few years back that he had been struggling, and that he ran a long short, as he used, value convergence strategy, buy something at 10 times earnings that's growing at 20% with a positive rate of change, short something at 20 times earnings that's growing at 10% with a negative rate of change. And if you get that right, you will get the stocks right. And what he found is it stopped working. And what he wrote to investors is, my performance is better. And one of the reasons is because I've spent time with Michael Green. And I have gotten a better understanding of why there is no longer an efficient value convergence. And that is around your work and the work that you've built on from other more academic work, let's say, to just show the distortions that stem from the growth of passive investing. And I'm sorry to ask such a long-winded cable news type question, but you'll get a chance. But people have to understand how, when Mike, because I always get this pushback when I talk about this, because people say, passive's been great for me. Passive's taken down my costs. Passive is taken down. That is not the critique. The critique is it gets to a certain size and a percentage of flows where it distorts markets. So I'm sorry for that. If you could talk a little bit about your interaction with Einhorn and your work.
Yeah, so this has been one of these interesting experiences. If you told me in 2016, when I was taking a sabbatical in between my hedge fund and working for Peter Thiel and really trying to understand what was transpiring in markets, because around 2015, 2016, most people who had a value bias had kind of come to the conclusion that markets were deeply overvalued, certain behaviors should be manifesting themselves. And candidly, they just failed to materialize. The sell-off in early 2016 was largely tied to China and oil, and then rebounded very, very quickly. Behaviors changed in a fairly meaningful fashion. And a lot of us, I think, were looking at this going, what is actually going on here? What's happening? The narrative of monetary printing or debasement, et cetera, was around at that time as well. But it really didn't explain much of the behavior that we were seeing. I was really fortunate that during that time period, a partner at AQR by the name of Lasse Peterson published a paper called Sharpening the Arithmetic of Active Management. Now, this paper was kind of the first in a series of papers that began to actually evaluate passive from a new dimension, instead of simply thinking about what size could it get to or how should it impact alpha under a traditional type framework. It started to think about the impact of what do passive flows or passive trading mean. And can I share slides? Is that
absolutely, yeah.
Okay, so kind of the most important thing to understand about passive itself is the definition of what a passive investor is supposed to be. And so this is from a slide deck that I share on a fairly regular basis. Let's see here. Sharing my screen. What is passive investing? This is drawn from Bill Sharp's The Arithmetic of Active Management in 1991. This is the source of all of the insight that ultimately active and passive own the same portfolios. Therefore, the only difference between the two is going to be the management fee costs associated with active versus passive, meaning passive should outperform over time. What Lasse caught in this was a footnote that defines what a passive investor is. A passive investor always holds every security from the market, and an active investor is one who is not passive. Well, the problem with holding is, how do you get into the market? How do you get out of the market? It's magic. And this literally is actually the assumption that Bill Sharp makes, that they trade during the liminal hours in which markets are not actually open. Lasse recognized that something very important happened when an index rebalanced itself, that forced passive investors to trade. And therefore, during that time period, they became active investors, and there had to be ways to exploit that phenomenon. Interestingly enough, this has led to the largest hedge fund business, which is index arbitrage, and is really built on this insight from Lasse. Although people were doing it beforehand, it really took on a new urgency and an understanding of the opportunity for outperformance during this time period. My insight was, I would argue, probably less immediate, but more impactful over time, which is that's one way in which portfolios change. If the index changes, that forces the underlying portfolio to change. But the second source of trading activity is the contribution of cash or withdrawal of cash from that same fund. And so that changes the structure of the portfolio and forces the passive managers to trade. Since those inflows and outflows, and it's almost always inflows, by the way, happen on a daily basis, that means passive investors are never passive. They're actually always active investors. And interestingly enough, Vanguard is actually out on a PR blitz highlighting how active their passive management is at this point. This is now almost a decade later. A decade ago, they would have argued we have no impact. We don't do any trading. We don't do anything different than the index, et cetera. Today, it's all about here are all the steps we take to maintain fidelity, right? And so the observation became, if they're not actually passive investors, what are they? And it turns out all they are is a systematic algorithm. And that systematic algorithm is really straightforward. If you give me cash, then buy. If you ask for cash, then sell. And if you recognize that that is your systematic algorithm, trying to evaluate how passive has influenced markets and how it will continue to influence markets and grow in its impact becomes much more straightforward. And that really has been the underlying source of a lot of the research that I've done. This has been one of those very fortunate components. I didn't have the benefit of all the academic research that has emerged in the post-2020 time period, beginning with an incredibly powerful paper called the Inelastic Market Hypothesis by Xavier Gabaix and Gabaix Koijen, that has unfortunately really validated the work and the concerns that I have around the impact of a systematic algorithm with that simplicity becoming the dominant style of investing.
Yeah, you use the word inelastic, and I heard you talking about this. Like, where else do we know in the economy? Maybe art, I was thinking, but where the price of something can go up and the demand for that product goes up more.
Yeah, you actually hit on something that I'm working on. I'm actually working on my own first academic paper because that insight, as simple as you might think it be, what you're describing is an upward sloping demand curve. And so if you think about traditional economic analysis, the quantity of something demanded rises as the price falls, right? If gasoline is $7 a gallon, I'm going to buy less gasoline than if gasoline is at $3 a gallon. I'll make fewer recreational trips, et cetera. I may choose to carpool, et cetera, et cetera, et cetera. What you just described is really the critical insight, which is if markets are inelastic, in other words, they can't simply absorb with no price impact the flow from investors. And this is really what the work of Gabaix and Koijen on the inelastic market was. The traditional models, things like the efficient market hypothesis, believe that markets are highly elastic. They can basically absorb anything that is thrown at them, with only change being basically the bid-ask price differential. In very specific terms, the EMH assumes that $1 invested into the stock market creates about 1 penny of incremental market capitalization. This is very simple, right? For every buyer, there's a seller. Somebody had to sell, therefore it should have reduced it. It turns out that markets are actually highly inelastic. And that was the real insight that came from Gabaix and Koijen, which is that $1 into the market appears to create about $8 of market capitalization. That means that the EMH is misspecified about 800 to 1. And we complain about government, accuracy. When you're 800 to 1 off on your misspecification, you've made a pretty serious error in your modeling. My work actually suggests that because of that inelasticity, money flows into an index. It drives prices slightly higher in a manner that is not purely proportional. Ironically, it turns out that the largest stocks are the most affected by those inflows because the magnitude of the order size relative to the quantity that is traded, the actual liquidity of those instruments, is far higher, right? To put the actual parameters around that, if you invest $1,000 in an S&P 500 fund, you're going to put about $80 into NVIDIA, and you'll put about 2 pennies into Delta Airlines. The relative liquidity of those two is not that same magnitude, about 160 to 1. Instead, it's about 10 to 1. Right. And so the net impact is that the price increase for NVIDIA is going to be larger than the price increase for Delta Airlines. That changes the weighting within the index. And it means that the next dollar that comes in buys even more NVIDIA. Right. That's what's called a positive upward sloping demand curve, meaning more is demanded as the price rises. In economics, we see this very rarely. There are very few things that are referred to as Veblen goods, right, where they become more valuable as they go up in price. And those things, unfortunately, tend to create self-amplification, which is what we call a bubble.
Michael, we talk about kind of the great Holland of the Midwest over if globalization's attributed, but, you're talking about kind of upward demand slopes, everything going to NVIDIA, multinationals. I wonder how much of the distortion passive markets have created have been part of kind of the decline of these, middle America industrial towns too, right? I mean, if you're not getting the same flows you would otherwise get into mid cap and small cap companies out of Cleveland, for example.
Yeah, I think that's actually really, really important, because if you think about that pattern that I was describing, it means that more and more of the retirement and investment dollars, which are the tax advantage savings that not only are individuals contributing, but increasingly employers are matching, it means that more and more of that money is directed to companies that theoretically have no use for it. Right. And ironically, of course, they create a use for it. We call this the AI bubble that we're currently going through right now. Very similar in construction to the fiber optic and .com build out in its underlying construction. And most people acknowledge that it seems very low probability that you're going to get the sort of return off of this investment that you anticipate. And there's a wide variety of reasons why that'll ultimately play out. But it also has a really important implication in exactly as Drew was highlighting. It means less money is directed to the companies that actually do need it. And I would actually even take it a step further and highlight that the decision by the U.S. government with the 2006 Pension Protection Act to establish 401ks as the automatic default for most people when saving for retirement, and then to further take a step by designating what's called a qualified default investment alternative, meaning this is a liability protected option that exists within the 401k. The company offering that option has protection against getting sued because of the selection of that choice. They chose, for very valid reasons, given the understanding at the time, to direct that towards passive investing, capturing low-cost diversification for most investors. But perversely, that actually means that money that could have been invested locally, right? I work at a Caterpillar factory in Peoria, Illinois. My retirement savings are now being sent to Silicon Valley in New York, right? Instead of being invested into local businesses, you've actually created a tax advantage, dramatically lower cost of capital, particularly on the equity side, for most large public companies, favoring them over small business. And my analysis increasingly suggests that this is having exactly the effect you would expect, which is the hollowing out of small business and entrepreneurship within the United States.
Yeah, that's a great question, Drew. The other side of that versus undervaluation of those entities that need investment is the risk of overvaluation of the mega caps. And this is something you talked about the other day, and it was some non-intuitive thoughts that you had on, obviously, overvaluation means there's more downside risk for investors. But could you talk a little bit more about how the perversion or the distortion from passive flows has led to the overvaluation in some sectors and what the implications are of that?
Well, this is actually it's ironic because as an outgrowth of the .com cycle, a very, very famous researcher named Michael Jensen, who unfortunately has now passed away, wrote a paper in 2004 called The Agency Costs of Overvalued Equities. And what he highlighted was in a period in which equity valuations are structurally and persistently overvalued, it actually creates all sorts of bad corporate behavior to effectively defend that valuation. He was in particular highlighting the investment boom around the dot-com, which is what's called a positive social bubble, in that capital formation was spent and money was spent on the internet that enabled many of the innovations that occurred over the next couple of decades, but at the same time was disastrous for many of the investors. That unfortunately is, I think, exactly what we're seeing again, right? You have companies that basically are perceived as being bulletproof. Their management teams are perceived as uniquely gifted. Their employees have become increasingly wealthy relative to the rest of the economy as their stock prices have been pushed higher, and stock-based compensation has enriched those individuals. And as the saying goes from Fiddler on the Roof by Jerome Robbins, when you're rich, they think you really know. This means venture capital and investment is now dominated by people who have built their businesses or built their wealth in exactly these types of social media or SaaS or AI type businesses over time.
Yeah. You would put out a piece the other day, and there was just an excerpt in there that I retweeted about this. Everybody's making money, and everybody looks around and they're saying these smart guys are making a lot of money. And boy, they've got a lot of conviction. Obviously, I'm paraphrasing. I guess I get it too. I don't really get it, but everybody kind of goes along with it because the smart guys, the richest guys, are killing it. So there's not just FOMO, but there's almost a sense of if the smartest guys are making all this money, they got to be right.
Well, I think there's that. And then ironically, there's also the reverse component to it as well, right? Which is the traditional expertise that has existed for things like valuing securities is increasingly dispensed. Again, a feature of the dot-com where we dispensed with all the traditional valuation metrics. We went after things like eyeballs, et cetera, unique viewers, et cetera, et cetera, et cetera. Today, we're doing the same thing, right? You know, what is the multiple of Bitcoin we should be priced at if we become a Bitcoin treasury, right? We start declaring things as income that are actually various forms of risk transfer. These are, accounting standards have deteriorated dramatically, and fraud is on the rise, as we see with First Brands and Tricolor, the recent bankruptcies that have just hit. And that's before we even get to the stuff in crypto, right? In terms of the type of fraud and bad behavior that we're seeing. And so, unfortunately, I just think that we're seeing history repeat itself. It's just ironic because most people have largely dismissed the dot-com cycle as, well, those were all unprofitable companies. Well, look at the nuclear companies that are roaring, or the quantum computing stocks that are roaring, or for that matter, properly evaluate the depreciation schedules of firms like Meta or Google or Microsoft relative to their stated cash flow levels, which are making assumptions around depreciation that seem aggressive, to say the least. Suddenly those companies are no longer nearly as profitable as they're reporting. We're seeing a record spread between things like GAAP EPS and operating EPS, where companies are basically saying, oh, well, ignore all that stuff, right? This is really how profitable we actually are. And when the inevitable write-offs occur against that, they'll just shrug and say, well, how could we possibly have known, right? None of that really matters as long as it's equity financed and it's being done with the cash on the balance sheet. The scale of the investment with AI has now started to switch that, and it's converting it to debt. And again, I bring up the Tricolor or First Brands bankruptcy. The unique feature of debt or adding leverage to a system is that debt and leverage carry a unique role within the capital structure. They embed change of control, right? And that actually means that you can enter into a situation in which suddenly the ownership of the assets shifts from the equity holders to the debt holders in very, very short order. And that sort of disruption is what we call a credit event. And candidly, there's a lot of evidence that we are already underway on one of those.
Yeah, because you brought up the dot-com bubble, I just was curious if you see any similarities in kind of the vendor financing we're seeing right now in terms of Oracle with the $300 billion spend on OpenAI, versus what was happening in Cisco in 2000s. Just any thoughts you might have on that, or if it reminds you of earlier on in your career when you were seeing that kind of thing.
It very much does, unfortunately. And I would highlight that there are a couple of different layers that are playing through, right? The vendor financing component, again, plays back to that very low, almost impossibly low cost of equity that many of these companies have. If I view my equity as effectively free and I end up pushing that, I end up deciding I need to grow my revenues, one of the easiest ways to do that is effectively to use my cash to give my customers the ability to borrow against my equipment. That does a number of things, right? If I'm providing the financing as NVIDIA to my customers, they're not going to comparison shop. They're not going to say, well, maybe I could use AMD equipment, or maybe I could use something else. They're simply going to say that's totally fine. It's actually going a step further than that, though. In deals like with CoreWeave, for example, NVIDIA has actually entered into an agreement where if CoreWeave is unable to generate an economic return on the GPUs, that NVIDIA is selling to them, NVIDIA is actually guaranteeing that they will make up that payment. Right? Now, that's what's called a variable interest entity or a contingent liability that ironically only hits the balance sheet once your results begin to deteriorate. Imagine the scenario in which CoreWeave is actually executing against that agreement. It's one in which there's an oversupply of NVIDIA GPUs that means they're capturing less revenue than they had anticipated for each of those GPUs. That means the price of NVIDIA GPUs should be falling. The quantity of sales should be declining. And all of a sudden they wake up and discover they've got a $10 to $20 billion liability to CoreWeave. CoreWeave is founded by a group by the name of Magnetar. For those who don't know them, they are among the smartest, most ruthless players in this space. They were actually the guys who really got the Big Short right. And I guarantee you that they are on the better side of this equation relative to NVIDIA.
Yeah, that's interesting. Yeah, you got to think there's going to be some lease accounting, some non-capitalized leases where a lot of the debt really ends up living.
Yeah, we absolutely see that. Meta, for example, is engaged in a fantastic increase in operating leases. This is one of these crazy things. You see the headline that comes across $26 billion worth of debt being raised out of PIMCO and $3 billion of first loss against Blue Owl. That sounds like an awful lot of debt. And it then gets magnified when you recognize that not only has Meta guaranteed that debt, they also have actually entered into an operating lease that commits them to make the operating cash payments for the operation of that data center. So again, it's that contingent liability that emerges if for some reason data centers don't fulfill the rosy outlooks that have been proposed for them. And there's a variety of ways that can come through. And I'll highlight something for the .com in just a second. But it means that Meta is now on the hook for spending and debt. Right. And so this is a very tricky situation. We've seen the balance sheets of many of the mega cap names deteriorate quite markedly over the last year. The reason I highlight that data center one is it's very similar to the fiber optic layout. So if you remember back to firms like Global Crossing or Level 3 Communications, they built fiber under the argument that there was an unlimited amount of demand for data. And they ended up being almost correct. Right? It really was a nearly unlimited demand. What they didn't anticipate is almost exactly what we're seeing begin to emerge in things like LLMs, the large language models that underpin much of the advances we've made in recent years on AI. The efficiency changed radically. So there was an introduction of two technologies, wave division multiplexing and amplification devices that basically meant you could use the same amount of fiber to transmit 1,000 times more data, right? And so the fiber optic network that was laid with the expectation of it was going to be basically 1 for 1. It ended up being 1,000 to 1. This led to a collapse in pricing. And despite the fact that we now transmit almost infinitely more data than we did in 2000, the revenues for the entire telecom industry have never eclipsed the peak from 2000, at least on a fiber transmission basis.
Yeah, WorldCom was one of the biggest companies in the world. I was at Morgan Stanley in capital markets at 2001, 2002, when you got to the other side for Global Crossing, and so many of those names went to zero really, really fast.
They went to zero really, really fast. And the other thing is, since you were in the capital markets side, you remember the terms under which many of these debt agreements were entered into. The simple reality is credit analysis is devilishly hard, right? Because you've effectively entered into an agreement where you receive a finite reward for 100% risk loss. One of the ways you're supposed to do that is through cash flows. Well, how do you project cash flows for a business? You have no idea what the underlying fundamentals are going to be. Well, you actually can look to the equity markets and say, how far down is this debt in the capital structure, right? And so if there's a $50 billion valuation and you're lending them $1 billion, as a credit investor, your shorthand is pretty much, man, I am so far down the capital stack that I really have no risk of loss associated with this. Until it actually turns out that $50 billion market cap has now fallen to $500 million. And the prospect of raising equity to pay off that credit is now non-existent. And so, that was really the magnitude, exactly as you're describing with the level 3s, Global Crossings, WorldCom, which obviously had a component of fraud associated with it. Same thing, right? That bad actor behavior associated with overvalued equities. Again, we're running the same risk here. Will it develop that way? We can't possibly know. But the early indications are that we're finding out that smaller models, once the training has been completed, smaller models that effectively break up the brain into various specialized areas of focus, not dissimilar to how specialization in labor markets allows us to be dramatically more efficient. We're now seeing that begin to emerge in LLMs, and the cost of those more specialized models are a fraction of the cost of the large, all-knowing models that exist.
Yeah, it is. I mean, it reminds me of the fiber build-out so much because, look, if you believe in that with AI, that the advancements in technology are only going to accelerate, then you have to believe that there's going to be creative destruction. You can't have one without the other. There will be winners. Maybe NVIDIA goes to 7 trillion, but there are going to be losers. There are going to be entities that didn't make the right bet on technology.
Yeah, I think that's right. Or even made the right bet on technology, and it's just everybody made the same bet. And so capacity ends up dramatically exceeding your underlying forecast and expectations. And so, I think it is almost a carbon copy of this. And by the way, it's not just the fiber build out. We saw the same thing with railways in the 19th century, canal building in the 19th century. Many forms of investment, the build out of utilities in the 1920s, et cetera, all of them led to the same underlying phenomenon, which is absolutely demand emerged, but it emerged at much lower prices than the models have been built for. My hunch is this is exactly where we're heading. We've already heard OpenAI say, hey, we're going to enable porn on our system. Right? That's telling you something. There's not unlimited demand when they suddenly say, oh, yeah, we're going to allow the most addictive conversational topic known to man, largely men, by the way, to be very clear, onto our network because they don't have real use.
Yeah. It reminds me of, at one point, I was at a hedge fund and my biggest position was Chesapeake Energy. And I thought Aubrey McClendon was going to be the richest man in the world. And what got in the way but technology? There was an emergence of a technology that made all of his investment that, to me, a relatively sophisticated investor, look really, really bad. And nobody in the energy field at that time thought that fracking was going to work. Everybody thought it was another experiment. This is what oil and energy companies do. They burn money when prices are high. And then it worked. And there is no sort of guessing as to how technological advances are going to evolve or at what rate they will evolve. I mean, look, you'd love to own all those assets now, and natural gas is going to be incredibly important, fueling the whole world. But he was early.
Absolutely. And, again, I think this is likely to be the same phenomenon. Again, that makes me super bullish on the long-term outlook for things we can do. And I actually want to emphasize this. I no longer really use Google. I use ChatGPT and Claude and Perplexity and various other components on a daily basis, right? They are indispensable tools for me at this point. They largely allow me to replace many of the resources that I might have had at prior periods in my career where I had tons of analysts working for me, et cetera. they're a force multiplier, right? It's like having 400 first-year analysts that are super eager to please me and do as much work as I possibly want them to do. Do I trust a first-year analyst to be correct in their analysis? No. But that multiplier is why I rely on them. They're a force multiplier. They can do a lot of stuff. And my role is largely reduced to error checking on a lot of this stuff. That requires domain-specific knowledge. There's a growing body of academic research around the implications of this. It basically takes old guys like me and gives us a new lease on life for a period of time, and unfortunately avoids my need to invest in younger people. I'm actually going on to a podcast later this evening that is called Passing the Torch. It's literally directed at younger people who are starting to enter the labor force and starting to evaluate how is their career going to exist? How would it be different? It's something that concerns me an awful lot because I think people are underinvesting in the next generation. And once again, everything from the way we do retirements to the manner in which we direct capital in our economy is accelerating that phenomenon. It's quite distressing from a socioeconomic standpoint.
Yeah, I want to be respectful of your time. So I just want to get quickly to that helps us transition to the economic question. Where are we in the economic cycle? You were talking about basically youth unemployment, and you have youth unemployment going up towards, I'm talking 20 to 24-year-olds going up towards 10%, while at the same time their participation rate falls dramatically. But where do you think we are in the economic cycle? You were somebody who very on was very clear that the BLS is not getting this right. The revisions are going to be dramatically to the downside. And you talked about one of the things that's changed, and you got this dead right, was the gig economy and the multiplier effect of new business starts. So just if you could explain what I just introduced there, and then just give us your thoughts on where we are, you think, in this business cycle.
Yeah, so this is one of the things I think is very hard for a lot of people to understand, because they see the unemployment report and they presume the unemployment report is capturing the same data, reporting the same data that it always has. There have been a number of very substantive changes in how that is calculated. Every single one of them individually is designed to actually make the system better. But again, collectively, they actually introduce a degree of bias that is simply wrong. And so the reason for the downward revisions is tied to something called the birth-death model. This is an attempt by the BLS to model new entrant firms into the economy and the job creation associated with those. That historically has been tuned to what are called employee identification number filings. Firms, when you launch a new firm, you have to file for an employee identification number, particularly if you are going to hire employees. That worked relatively well in smoothing stuff out until there was a substantive change in both how we measured it in the COVID period and then what we measured or what we captured with EINs beginning in 2021. With COVID, we basically decided, okay, we're going to dispense with the idea that businesses are going out of business because we believe there's so much new business creation that we're just going to ignore that portion of it, right? And by the way, that was somewhat true during a period of employee retention credits and paycheck protection program, et cetera. Incredible sums were transferred to employers to preserve employment. That obviously has now gone away. And the second factor that played in there was the change in reporting characteristics in the gig economy. So prior to 2021, you could earn up to $20,000 in income from a secondary business or an activity that didn't have to be captured by a 1099 report. In other words, I could work for Uber, I could make $16,000, and that would roughly be treated the same way as if I'd worked for cash under the table for my buddy at the bar. I didn't have to report that. In 2021, we changed those rules to a $600 threshold. And this led to a surge in employee identification numbers, which are a prerequisite for a 1099 form. You can use your own social security number, but there's many advantages to forming an LLC, et cetera. And the cost of doing so collapsed. You know, I actually spoke with people at the time who were specializing in creating LLCs for strippers and hookers and people working on OnlyFans, et cetera. I'm not necessarily linking all of those together, to be very clear, but you know, these are somewhat important to understand the data. The BLS interpreted this as a surge in entrepreneurship.
Right.
And it wasn't. It was just a reclassification, right? And that's led to a significant quantity of the downgrades and lower estimates that we now have for the jobs that were created. The second thing is actually tied to the gig economy itself, right? If you lose your job and you begin driving for Uber, which was not a possibility prior to 2012 when Uber X was introduced in response to competition from Lyft, you really couldn't do that prior to 2012. But post 2012, and then with the EIN change, you suddenly are no longer unemployed if you lose your job and you start driving for Uber, right? And this has meant that employment claims have remained very, very depressed for the simple reason that people have a choice. Do I get $475 a week from unemployment insurance in the state of California where I'm only eligible for 26 weeks? Or do I get roughly $1,200 to $1,300 worth of cash income from driving the car I already have and working for Uber, right? The answer to that is very straightforward, right? Filing for unemployment is actually an abusive process. You need to report to a parole agent to prove that you're looking for work, et cetera. Uber doesn't care, right? You can have flexibility. You can go pick your kid up from the baseball game when you want to. You can do all sorts of things. And so it's a much better individual role than unemployment insurance. But it also has an interesting socioeconomic component, which is the more people that end up driving for Uber, the more Uber wages start to fall, right? Unemployment works the exact opposite. The real value of unemployment rises during periods of slowing economic activity because more people have less disposable income. That raises the value of them. That's why unemployment insurance functions as insurance, whereas the camouflage of that hidden unemployment actually behaves much more like traditional employment roles and really just leads to a potential cliff where you exhaust that Uber capacity. We're starting to actually see increased evidence of that. There's a natural test for how important this is. And many people who are listening to this have probably gone through the experience where they had their first job. They went to rent a car at the airport and they discovered they couldn't rent a car because they were under the age of 25. Right? Unless you happen to work for a large corporation, it was very, very difficult. That is because of insurance rules that prohibit the use of various types of vehicles and various activities if you're under the age of 25. That means there's a natural experiment where about half the states have rules that prohibit those under the age of 25 from driving for Uber, and about half the people can qualify. And so there's a natural experiment. If we actually look at what's happening to unemployment, let me actually pull this up here. I'm going to share my screen again. We can actually see this in a very straightforward manner in the data. So this is simply looking at the Z-score, the level of unemployment relative to its trailing average. This orange line is the population in total that is eligible over the age of 25. It's basically unemployment for those over the age of 25 that would be eligible to drive for the gig economy. The blue line is those who are not eligible, or about half of whom are not eligible. Nowhere in the data sets have we seen a divergence develop like this before.
Right.
This is telling us that this is actually a really big deal. This is a really, really big deal that is dramatically understating the level of unemployment we have. And people who are driving for Uber because they lost their job, they feel unemployed, right? The government may not label them as such, but they're experiencing the economic distress and emotional distress of having lost their job and struggling to find a job that is concomitant with their skill set. That's creating all sorts of social issues and challenges. And we see this in the survey data, where the fears of losing your job, the perception of jobs hard to find relative to jobs easy to find, those are all consistent with dramatically higher unemployment rates than we're actually reporting. And that unfortunately contributes to a lack of trust in the economy, the growing awareness of what's called the K-shaped economy, where those who benefit from largely capital investment and interest income are doing extraordinarily well. And those who are actually trying to sell their labor, their time for wages, are increasingly stressed.
Yeah. And does the result of that mean that the markets now kind of wag the dog, the market tail wags the economy, that if 10% of the population is 50% of the consumption, as has been kind of widely discussed, does that mean that a market downturn that for whatever reason could be the catalyst for a pretty painful economic downturn?
Well, what it tells you in part is yes, that is true. Most people focus on the wealth effect of that, right? So if I have my 401k rise in value by $500,000, that is going to lead me to spend more money, right? The actual data on that is pretty straightforward, particularly in things like 401k accounts. An increase in wealth doesn't lead to a significant change in spending. That $500,000 increase typically translates to about $10,000 of increased spending on an annual basis, about 2% wealth effect when it's tied to equity markets. Where there's been a much more noticeable impact has ironically been the Fed hiking interest rates. So when the Fed hikes interest rates, that increases the income that people are receiving on their cash or their near cash assets. Those returns have exploded, and there's about $500 billion more money that is now flowing into the interest income sector than there is on the interest expense side, because people had largely fixed many of their types of debt, mortgages, et cetera. That incremental $350 billion has about a 70% marginal propensity to spend. And my guess is in your RIA business, you see this. You see the clients that suddenly have much higher cash income because of their interest income, suddenly saying, okay, well, this is recurring. This is not, a one-off gain in the stock market that could be lost in 2008 or 2000. This is something that I can actually spend. I'm going to go on that cruise trip with my grandchildren. I'm going to help my children buy a home. All of these things are supporting the side of the economy that is that upward slope in the K-shaped economy. While again, those who are less resourced are increasingly struggling and are relying on things like buy now, pay later. Something like 25% of people have now admitted to using buy now, pay later to pay for groceries in that demographic. That's an extraordinary statistic, right? And it speaks to the lack of income and the need to make that up, particularly in a time period in which we've seen the price level rise more than most people's individual incomes have.
Right. It's kind of it's something the MMT guys have really sort of gotten right. They've gotten a lot right, in fairness to them. I'm not sure about Stephanie Kelton, but some of the other would certainly have. And it's also with the COLA adjustments on Social Security, right? That you've gotten a big lift for incomes. And it also just shows how reliant this economy is on that kind of 65 and over cohort that are living on savings, and they're getting a much, much better return on those savings than they have historically.
Well, and it also speaks, though, to one of the perverse components that you increasingly, I'm sure, see in your RIA. It leads to the concept of, well, I've saved in my 401k. I've now accumulated enough assets, or if I'm beyond that 401k and other sources, you're increasingly hearing people talk about bequests, right? What can I leave for my children?
Sure.
Well, the irony behind how we finance our retirement in the United States is that it's largely an equity centric, not meaning that it's overly allocated to equity, but we fund our retirement out of what we have, right? The equity that we own in ourselves, that 401k, my stock savings, the ownership of my house, et cetera. Those are the sources of insurance for my retirement. If I'm saving, if my retirement is actually not tied to something like an annuity that gives me a predictable stream of cash flows, ironically, what I need to do in order to increase my spending is have even more saved, right? I save more and more and more, and I accumulate those assets. Perversely, retirement is supposed to be the time period in which you're spending down those assets and buying the products from the younger people who are actually working. This is how Social Security is structured, right? The younger people are supposed to benefit from the older people's spending. We're not seeing that because the older generation is underspending relative to what you might expect given their wealth, because that wealth is held in an uncertain form, right? They just need to save more and more and more. And it, again, contributes to that nihilism that exists in the younger generation, where they see the extraordinary wealth that their parents have to have in order to feel comfortable. And they basically say there's no prospect of me getting there given my current income trajectory and the potential to save in traditional assets. And so they start gambling, right?
Yeah.
And we see this throughout the economy. And it's an incredibly distressing framework. I'm sure your children and certainly my children have been raised in an environment in which they are better resourced. And I watch the slow path of accumulation that they're engaged in and the success that they're experiencing. And I just really deeply feel for kids who are trapped in a very different role and different model.
Yeah, well, it's certainly true. I have sons that are 26 and 28, and I live in Summit, New Jersey, which is a affluent commuter town to New York. And I definitely have that conversation where they're saying, how am I going to buy a house in Summit? Like help me understand that. And it really is probably going to come down to that generational wealth transfer. But Mike, I want to be respectful of your time. We're at the end of the hour. This has been an education. It's been great. Thank you so much for coming on. Let us know if we can ever do something for you, and thanks.
Well, spreading the message and helping people understand the situation that we're in right now is really a service unto itself. And so I'm really thankful for the opportunity to speak and appreciate you taking the time.
Great. Thank you very much.
Thanks, gentlemen. Thanks, Michael.